Washington, the Senate Chamber, July 3, 1909. It is a hot Saturday at the end of a long session, and the Senate is grinding through a tariff bill. A senator from Nebraska named Norris Brown asks for unanimous consent to lay something before the chamber and put it to a vote. What he is holding is a constitutional amendment, 30 words. It would give Congress the power to lay and collect taxes on incomes from whatever source derived without apportionment among the states and without regard to any census. Those 30 words will one day take a slice out of every pay envelope in America every 2 weeks, for the whole of a working life. Nobody in that chamber thinks that is what is on the table. In 1909, nobody in that chamber is wrong, and the most powerful man in the room does not stand in its way. You probably do not know his name. Nelson Aldrich, senator from Rhode Island for 28 years, chairman of the Finance Committee. The newspapers called him the general manager of the nation, and they were not being entirely sarcastic. For 20 years, Nelson Aldrich had been the wall that every attempt to tax income in America had broken against. Here's what he says, and it is in the Congressional Record at page 4067. I have no objection, with the understanding that there is to be no discussion or the discussion must be limited. Read that again? Not, I object, not over my dead body, I have no objection. 2 days later, on the 5th of July, the Senate votes, 77 to nothing. Not a single senator votes against it. Aldrich votes yes, so does Joseph Bailey of Texas. The Democrat whose income tax bill Aldrich was in the middle of strangling. So does Boyce Penrose of Pennsylvania, whose state will never ratify it. A week later, the House passes it too, 318 to 14. And on that day, on the floor of the House, a New York Democrat named William Sulzer stood up and said out loud what he thought was happening. He was not deceived, he said, by the unanimity with which the resolution was being rushed through by its 11th-hour friends. They never expected to see it become part of the Constitution. Their real purpose was to stop it from ever being ratified by 3/4 of the state legislatures, to have it killed, quietly, in the Republican state houses. He was telling the House that the amendment was a trap, a disposal mechanism wearing the costume of a reform. And then it did not die. 3 years and 7 months after that afternoon, on the 25th of February, 1913, the Secretary of State certified that the 16th Amendment to the Constitution had been ratified by the states. 7 months after that, the United States had an income tax. So that is the first strange thing about the tax that comes out of your paycheck every 2 weeks. It was put into the Constitution, in large part, by the people who were trying to prevent it. Here's the second strange thing. When it arrived, it barely touched anybody. In its first year, the income tax was paid by roughly 1 American in 270. The top rate, 7%, was reached by 135 people in the entire country. And the third strange thing is the one that ties them together, and it is the reason for this video. Nobody ever voted to change that. There was no Second Amendment, no referendum, no moment where the American people were asked whether a tax written for 135 men should apply to a school teacher. The scope changed anyway. It changed twice, both times inside 18 months, both times during a war, and both times through a mechanism so boring that almost nobody noticed it happening. This is the history you were not taught. Let me put the argument plainly, and then I am going to spend a good part of this video attacking my own argument, because one half of it is wrong, and I would rather tell you that myself. The American income tax was not created to fund the government. It was created as a weapon in a fight about something else entirely, the tariff, the tax on imported goods, which was the oldest and most bitterly political question in American life. The men who passed it in 1913 said so on the floor of Congress. Several of them explicitly denied that the point was to redistribute anything. What turned that weapon into the largest revenue source in the history of the world was not a change of heart. It was a change of threshold. And thresholds move without anybody voting. Start with the money, because everything here is the money. To understand why an income tax was such a violent idea in America, you first have to understand how the federal government actually paid for itself before 1913. And there is a number about this that is repeated constantly and is wrong. You will hear that before the income tax, the tariff supplied 90% of federal revenue. You will hear it in documentaries, in podcasts, in comment sections. It is wrong by a distance, and the correction is more interesting than the myth. That 90% figure is real, but it belongs to a different century. Before 1861, customs duties were roughly 9/10 of federal receipts. After the Civil War, as the economic historian Douglas Irwin puts it, it was only about half. And by 1913, it was not even that. Go to the Treasury Department's own combined statement for fiscal 1913. Total ordinary receipts, $724 million. Customs, $318 million. That is 44%. The other pillar was internal revenue, the excise taxes above all on alcohol and tobacco, $309 million, plus the new tax on corporations, $35 million. Add them together, and internal revenue comes to $344 million, which is more than customs, and it had already passed customs the year before in 1912. Read that again because it matters for everything that follows. The tariff had already lost first place before the income tax existed. So the federal government of 1912 ran on two things, a tax on what you imported and a tax on what you drank and smoked. Both of them are taxes on consumption. Both of them are invisible. They arrive inside the price of a thing and nobody hands you a bill. And both of them fall hardest on people who spend all of what they earn. That is the part that gets left out of the story. A tariff is a sales tax with a foreign policy attached. When Congress puts a duty on wool, the man who buys 1 coat a year pays it in the price of the coat. So does the man who buys 30 coats. As a share of income, the first man pays vastly more. There is a historian, Robin Einhorn, who pushes this in a direction that is genuinely uncomfortable. Her argument is not that the customs house robbed one region to enrich another. It is that America ended up funding itself at the border in the first place because slaveholders wanted it that way. A tax collected on goods as they come off a ship never requires anybody to sit down and put a value on human property. It never forces a national argument about who owns what. On that reading, the reason there was no income tax for America to inherit in 1913 is not an economic accident. It is slavery. That is a real revision, and I flag that it is not the settled view. But hold on to it, because the question of where federal money should come from was never only a question about rich and poor. Now, the obvious objection: if a tax on income is so much fairer, why did it need a constitutional amendment at all? Congress taxes things. That is what Congress does. And here is where the story doubles back on itself, because the answer is that Congress had already done it twice and gotten away with it once. The United States had an income tax during the Civil War. It ran from 1862 to 1872. It helped pay for the Union armies, and when it was challenged, the Supreme Court upheld it unanimously in a case called Springer against the United States in 1881. So the question was settled. An income tax was constitutional. Everybody knew it. Then in 1894, a Democratic Congress passed another one, 2% on incomes above $4,000, and the Supreme Court took it apart. The case is Pollock against Farmers Loan and Trust Company, decided in 1895, and it turns on one of the most technical clauses in the Constitution. Direct taxes have to be apportioned among the states by population. If your state has 5% of the people, it has to produce 5% of a direct tax, regardless of whether it has 5% of the money. Apportionment makes an income tax arithmetically impossible. To collect a proportional share from a poor state, you would have to tax its residents at a punishing rate, and to collect the same share from a rich one, you would tax them at almost nothing. For a century, the courts had held that an income tax was not a direct tax. In 1895, the court changed its mind, decided that a tax on income from property was in substance a tax on the property itself, and struck the law down. By 5 votes to 4. 1 vote. And that is why an amendment was needed, not to give Congress a new power to undo a single sentence written by a single justice in 1895. Keep that distinction in your head. It is the thing the loudest argument about this amendment gets backwards, and we are coming back to it at the end. Which brings us back to that hot Senate chamber in 1909, and to the trap. The 1909 session was supposed to be about the tariff, and only the tariff. William Howard Taft had been elected promising to bring rates down. The bill that came out of the House was a modest reduction. The bill that came out of Nelson Aldrich's Finance Committee had, by some counts, over 800 amendments, most of them going the wrong way. And a block of insurgent Republicans from the farm states, men like Albert Cummins of Iowa, went into open revolt against their own party leadership and joined forces with Democrats like Joseph Bailey of Texas. Their weapon was an income tax. They attached it to the tariff bill as an amendment, and by the middle of June 1909, they had the votes. This is the moment the whole story turns on. Aldrich was going to lose, not eventually that week. So on the 16th of June, President Taft sent a message to Congress, and it is a masterpiece of the genre. He proposed 2 things. A tax on corporations structured as an excise on the privilege of doing business, and a constitutional amendment authorizing a tax on incomes. The argument he made in public was legal and frankly quite respectable. For Congress to pass an income tax law in defiance of Pollock, he wrote, would be to assume that the court will reverse itself and that, he warned, will not strengthen popular confidence in the stability of judicial construction of the Constitution. Follow the mechanism because it is beautiful, and it is deadly. If you are an insurgent senator who wants an income tax this year, what can you say against a constitutional amendment for an income tax? Nothing. You cannot vote against it. You would be voting against your own cause. But if the amendment is on the table, then the immediate bill, the one that would take effect this year, the one Aldrich was about to lose, becomes premature. Why legislate now when the proper constitutional route is right there? The insurgents' bill went away. And in its place went a proposal that would now have to be ratified by 3/4 of the state legislatures. 46 states then, 48 by the time it was finished, most of which met only every other year, many of which were controlled by exactly the interests that had spent 20 years fighting this. And I do not have to reconstruct any of this from motives because Aldrich said it himself out loud on the 29th of June. He was talking about the other half of Taft's package, the tax on corporations, and here's the sentence at page 3929 of the Congressional Record. I shall vote for a corporation tax, he said, as a means to defeat the income tax. The senator sitting across from him, Alexander Clay of Georgia, replied, I think that is an honest statement. Joseph Bailey, whose bill was the one being killed, was less gracious. He commended the statement of the senator from Rhode Island. He said, to those senators who claimed to favor an income tax and who were joining him in this subterfuge to defeat it. Subterfuge. The word is in the record, on the same page, spoken to Aldrich's face. And 2 days later, William Borah of Idaho, a Republican who wanted an income tax, and who would spend the next 4 years defending the amendment in public, said the same thing from the other side. It was proven beyond peradventure of doubt, he said, that the corporation tax had its origin in the desire to defeat the income tax. When it had served that purpose, it would die an ignominious death. They were not guessing at a hidden motive. They were describing a parliamentary maneuver they were watching happen, in the room, while it happened. And 9 days after that, Sulzer told the House what the other half of the package was for. And that is why the vote was 77-0. Both sides thought they had won. One side was voting for an income tax, the other side was voting to postpone one, probably forever. Now, here's where most tellings of this story stop being careful. I am not going to. What Aldrich said on the 29th of June is that a corporation tax was a means to defeat an income tax that is on the record, and it is not in dispute. What he never said, anywhere, in any document anyone has produced, is that he expected the constitutional amendment to fail in the states. That part is an inference. Sheldon Pollack, the legal historian who has done the most work on this, writes about the sinister motive attributed to Aldrich, and that word attributed is doing real work. His own biographer suggests something else entirely, that the point was to split the Democrats from the insurgent Republicans. What is not an inference is the pattern of who refused. Because the amendment did go out to the states, and 6 states never ratified it. Here they are: Rhode Island, Connecticut, Pennsylvania, Virginia, Florida, Utah. Rhode Island is Nelson Aldrich's state. Utah is Reed Smoot's. Pennsylvania is Boys Penrose's. Every one of those men was a pillar of the Senate leadership that had put the amendment on the table in the first place. And look at where those 6 sit. Rhode Island, Connecticut, Pennsylvania, the industrial Northeast, which is precisely what the protective tariff had been built to protect. Add Utah and Reed Smoot, and 4 of the 6 are explained by interest rather than by principle. The 2 that do not fit are Virginia and Florida. They are the reminder that no map explains everything. And in April 1910, Aldrich's own hometown paper, the Providence Evening Bulletin, charged in print that its senator had supported the amendment only as a means of staving off the immediate enactment of an income tax law. That is still an accusation, not a document. But it is an accusation made at the time in his own state by the people who knew him best. But it failed. 36 states were needed. 38 had ratified by the time the Secretary of State signed, and 42 would ratify in the end. And here is where the threads converge, because the reason it failed is almost comic in its ordinariness. The men who designed the trap were experts in the United States Senate. They were not experts in state legislatures, where an amendment could be sold to a farm state assembly with one sentence: only the rich will pay. The historian John Bwenker, who wrote the definitive study of how this amendment got through, put it in a line I cannot improve on. Seldom, he wrote, has a measure of such monumental importance been enacted with less conviction or enthusiasm. Nobody was passionate. Everybody assumed it would touch somebody else. There is one more thing about ratification you need, because it is the raw material of an entire industry of nonsense that we will come back to. When the ratifications arrived in Washington, the paperwork was a mess. State legislatures had copied the 30 words out by hand and by typewriter, and they had made small errors. Illinois wrote remuneration where the text said enumeration. Missouri wrote levy where it said lay. Washington wrote income where it said incomes. Capital letters wandered. commas appeared and vanished. Out of 37 instruments, only 4 repeated the language exactly as Congress had approved it. The solicitor of the State Department went through them, decided the variations were trivial, and wrote that down. On the 25th of February, 1913, Secretary of State Philander Knox certified the amendment as ratified.
Hold that. It comes back.
So now the amendment exists, and in April 1913, a new president arrives to use it, and watch what he actually talks about. On the 8th of April, 1913, Woodrow Wilson went up to Capitol Hill and delivered his message to Congress in person. No president had done that since John Adams. 112 years of presidents had sent a clerk with a written text because addressing the legislature in person was thought to smell of monarchy. Wilson broke the tradition to make a speech, and the speech is about the tariff, all of it. He does not use the phrase income tax. The bill that follows is the Underwood Tariff Act, and everything about it tells you what it was for. It cut duties on taxable imports from about 40% to about 26%. It moved around 100 articles onto the free list: raw wool, iron and steel, farm machinery, wheat, coal, lumber. It is first and last a tariff bill. And buried in it, in Section 2, is the income tax. It was drafted largely by a young congressman from Tennessee named Cordell Hull, the same Cordell Hull who would later spend 11 years as Secretary of State and win a Nobel Prize. Back in 1909, at the end of a long attack on the tariff, Hull had put a question to the House. How long, he asked, will or can the country endure this system? Until we can secure the imposition of an income tax and thereby destroy it. Thereby destroy it. It is the tariff. The income tax was the instrument, the tariff was the target. Hold that sentence too. It is the half of my argument that survives the evidence. The other half, the half about the money, does not, and in a few minutes I'm going to take it apart myself. Now look at what Section 2 actually said, because this is where the modern myth dies. A normal tax of 1% on income above the exemption. The exemption $3,000 for a single person, $4,000 for a married couple. Then a surtax, beginning at $20,000, climbing in steps to a top rate of 7% on income above $500,000. 1%, 7 at the top. And that exemption is the number that tells you everything. Income per head in the United States in 1913 was about $333 a year. The exemption was $3,000. The income tax began at 9 times the income of the average American. For the tax year 1913, 357,598 returns were filed in a country of about 97 million people. That is roughly 1 American in 270, well under 1% of the population, about 2% of households. And at the top of the scale, 135 people in the entire United States reported income above $500,000. This is not a mass tax. It is not remotely a mass tax. It is a tax on a specific and very small room full of people, and the men who wrote it said so. In fact, and this is the detail I find hardest to square with the way the story is usually told, the Democrats who passed it went out of their way to deny that redistribution was the point. John Sharp Williams of Mississippi, on the floor of the Senate in August 1913, and note who he was answering. Not a conservative, a progressive Republican pushing to drive the top rate far higher and add an inheritance tax on top of it. Williams's reply was this: the object of taxation is not to leave men with equal incomes after you have taxed them. And here is the part that should stop you. The next day, Henry Cabot Lodge, Republican, Massachusetts, no friend of this bill, stood up and quoted him back with approval. He had been extremely glad to hear it, he said. Lodge's own position was that he wanted the man with $1,000 to pay his dollar, and that he would put the heaviest burden on income that was unearned. What he warned against was pushing the top rates so high that you converted the imposition of a tax into the pillage of a class. Read that again. The Democrat writing the tax says it is not about equalizing incomes. The Republican opposing the bill says he agrees and that he is willing to pay. That is not a class war breaking out. That is 2 men arguing about where the money should come from instead of the tariff. Sheldon Pollock's summary of the whole affair is the cleanest sentence written about it. Few who voted for the impost, he writes, advocated income taxation as a means to redistribute wealth. And the adoption of the modern income tax, he concludes, was the unintended consequence of a strategic blunder by the conservative leadership of the Republican Party. The first filing deadline was March 1st, 1914. And the thing I want you to picture is not a crowd at a counter. It is the piece of paper. 4 pages, 20 numbered instructions. That is the entire federal income tax of the United States of America, the whole apparatus, printed on 4 sheets for a country of 97 million people. 4 pages. Hold that too. And now I have to break my own argument, because if I do not, somebody in the comments will, and they will be right. I have been telling you that the income tax was a replacement for the tariff. As a description of the political fight that is solid, it is in Hull's own words, it is in the structure of the bill, it is where the entire literature now sits. As a description of the money, it is false, and you can check it in about 30 seconds. Here are the numbers, and I'm going to give you the version that is least flattering to my own argument first. Between 1913 and 1915, customs receipts fell by $109 million. Over the same period, the whole income tax column rose by $45 million. 45 against 109, about 2/5 of the whole. And if you want to be generous to me, because that 1913 column was not really an income tax yet, it was the corporation excise of 1909. Then start it from zero, and it still covers only 3/4. Either way, it does not close. And total federal receipts did not hold steady either. They fell. In 1915, the government of the United States ran a deficit of $63 million. The income tax did not replace the tariff revenue. It did not come close. And here's the piece of evidence that really settles it, because it is not an estimate, it is a decision. In the late summer of 1914, war broke out in Europe, trade convulsed, and the Treasury genuinely ran short. On the 4th of September, Wilson went to Congress and asked for $100 million. And what happened next is better than the story I was about to tell you. The two men who ran the tax writing committees, Underwood in the House, Simmons in the Senate, went to work, and their first instinct was to reach for the income tax. They meant it to cover a third of the $100 million. Wilson called them back to the White House and told them to take it out. Not because he objected to the tax, because an income tax collects a year in arrears, and he needed the money that winter. Underwood came out and told the reporters, "We will have to start all over again." So on the 22nd of October, 1914, Congress passed the Emergency Internal Revenue Tax Act, and it taxed beer, wine, liquor dealers, tobacco, telephone calls, theaters and amusement places, bankers, brokers, perfume, and chewing gum. There is not one income tax provision in it. Think about what that tells you. 20 months after America got the constitutional power to tax income, facing a real revenue emergency, the government reached for it, looked at the calendar, and taxed chewing gum instead. Because the income tax was not in 1914 a revenue instrument. It was a political settlement. It was the thing that made it possible to cut the tariff without being accused of bankrupting the Treasury, and its actual job was to be small. So let me restate the thesis honestly in the form the evidence supports. The income tax replaced the tariff politically, not fiscally. It was the price of admission for tariff reform. In 1915, after 2 full years of the income tax, close to 9/10 of federal revenue still came from taxes on consumption. Which means the tax that now takes half of what Washington spends was not built to raise money at all. It was built to win an argument, and nothing was ever rebuilt when the job changed. The wars just moved the number. And the correction cuts both ways, because it damages the sentimental version of this story too. The 1913 income tax did not make American federal taxation progressive. It made a consumption tax system very slightly less regressive at the top. But there's one more fact about that 1913 law, and it is the strangest fact in this entire story, and almost nobody knows it. Go to Section 2, subsection E, page 170 of Volume 38 of the Statutes at Large, and read the categories of people required to do something. Executors, administrators, agents, receivers, conservators, employers, and all officers and employees of the United States having control of interest, rent, salaries, wages. They are, in the words of the statute, hereby authorized and required to deduct and withhold. Withholding. Money taken out of your pay before it reaches your hand. It is in the original law. It took effect on the 1st of November, 1913. And you do not have to take my word for it, because it is printed on the first Form 1040 ever issued. Page 2, Column A, amount of income on which tax has been deducted and withheld at the source. And America did not invent withholding in 1913 either. It had already done it during the Civil War, on the salaries of federal officials and on the interest and dividends paid out by railroads and banks. What matters is that it is here in black and white in the founding statute of the modern income tax. Then Congress changed its mind. 4 years later, in the Revenue Act of 1917, Congress cut it back to foreign residents only. And it went further than that. It ordered that everything already withheld from American citizens during 1917 be released and paid back to them. The country tried taking money out of pay packets, disliked it, and gave the money back. Remember that? Because everything you're about to hear about 1943 is not an invention, it is a return. Now the war. Everything so far has been about a small tax on a small number of people, argued about by men in a chamber. What happens next happens in about 18 months, and it changes the meaning of the words. The United States entered the First World War in April 1917, and by October Congress had passed the War Revenue Act. Look at what it does to the top rate, and you get one story. The rate had already crept from 7% to 15% in 1960. In October 1917, it goes to 67%. But the top rate is not the mechanism. Almost nobody's life is changed by the top rate, by definition. The mechanism is the exemption. It went from $3,000 to $1,000 for a single person, and from $4,000 to $2,000 for a married couple. 2/3 of the wall removed in one bill. And here is what that did. In 1916, 437,000 income tax returns were filed. In 1917, 3,473,000. 8 times as many taxpayers in a single year, not because anybody's income had grown eightfold, because the line moved. Nobody had voted on where that line should sit. There is no line in the Constitution. That is the mechanism this entire story turns on, and this is the first time you can watch it do its work. The revenue does something that is genuinely difficult to comprehend. Income and profits taxes together were $80 million in 1915. By 1918, they were $2,852 million. 35 times in 3 years. Income and profits taxes had been something like 4% of federal revenue in 1913. By 1918, they were something like 3/4 of it. And notice what carried most of that load, because it is the least remembered tax in American history. The excess profits tax was a tax on corporate earnings above a normal peacetime rate of return on the profit a company made only because there was a war on. It took $1.6 billion out of 1917 profits, $2.5 billion out of 1918, $1.4 billion out of 1919. In 1918, the corporate side of the ledger was 3/4 of everything the income tax brought in. The government did not primarily tax war wages. It taxed war profits. There is a small human scene in the middle of this that I like, because it shows how far the politics had twisted. The chairman of the House Ways and Means Committee was Claude Kitchin of North Carolina, a Southern Democrat who had voted against declaring war, and who then wrote the taxes to pay for it with visible enthusiasm. In the next revenue bill, the one Congress did not finish until February 1919, Kitchin extended the income tax to the salary of the President of the United States. Wilson considered a veto, and Colonel House talked him out of it. Afterwards, Wilson described Kitchin with what I can only read as exhausted admiration, as that distinguished, stubborn North Carolinian who, when he made up his mind, would never open it. After the war, rates came down, but the base, the number of people inside the system, never went back to where it had been. There is a name for this. The economists Peacock and Wiseman called it a displacement effect. A war raises what a society will tolerate paying, and when the war ends, the tolerance does not fully go back down. Their evidence was British, and the empirical support for the model is thinner than the popularity of the phrase suggests. But look at what happened here and tell me what else to call it. W. Eliot Brownlee, the dean of this field, puts it flatly. Without American intervention in the First World War, he writes, and without the way the leaders of the Democratic Party managed that intervention, the development of federal taxation would have proceeded far more incrementally. Which brings us to the Second War, and to the 18 months in which the income tax became yours. In 1939, about 5% of American workers paid federal income tax. It was still essentially what it had been in 1913, a tax on the top of the distribution filed once a year by people with accountants. Then the Revenue Act of 1942. It was called at the time the greatest tax bill in American history, and it did the same thing 1917 had done, only more so. It drove the exemptions down into ordinary wages, and it added something called the victory tax, 5% on income, above $624 a year collected by the employer. $624, remember 1913, where the tax started at 9 times the income of the average American. By 1943, the filing threshold was $500, and income per head was over $1,100. 9 times average income down to less than half of it. In 30 years, without a single amendment, referendum, or vote on the question of scope. The number of returns went from 7.5 million in 1939 to nearly 50 million in 1945. The share of the workforce paying went from about 5% to roughly 3/4. And the income tax went from 13% of federal revenue in 1940 to 45% in 1944. It had become the largest single source of money the American government had, and it has never given the place back. Remember the 4-page form and the 357,000 returns filed on it? By 1945, the same system was taking in 50 million, 140 times as many in 31 years. And then there was a problem, and the problem is the most interesting part. You cannot run a mass income tax the way you run an elite one. Under the old system, you paid in the year after you earned out of savings. That works for a man with a portfolio. It does not work for a machinist who has spent his wages, and it produced a genuine crisis, millions of new taxpayers in March owing money they no longer had. Into this walks Beardsley Rumel, chairman of the Federal Reserve Bank of New York and, in his day job, the treasurer of Macy's department store. And Rumel had watched the problem happen to his own staff. An employee who retired, stopped earning, and then the following spring got a bill for the tax on the year he had just stopped earning. His plan was pay as you go, take the tax out of the pay packet, week by week as it is earned. The political fight was vicious, because the switch created a problem. If 1943 taxes are withheld during 1943, and 1942 taxes are still due in 1943, people owe 2 years at once. Rummel's answer was to forgive one. The chairman of Ways and Means, Robert Doughton, called it the biggest outrage ever attempted to be perpetrated upon the people of the United States. They compromised. The current Tax Payment Act was signed on June 9, 1943. The 1942 liability was discharged rather than canceled, with a quarter of it carried forward for larger taxpayers. And America went back to taking money out of pay envelopes 30 years after it had first tried and abandoned exactly that. And the Internal Revenue Service's own history of the period does not call 1943 an invention. It calls it a reenactment. And one piece of honesty about withholding, while we are standing next to it, I can show you that the threshold moved and that the wars moved it. I cannot show you that withholding by itself made the American state bigger. No study isolates that effect at the federal level. What exists is suggestive. Work on the American states finds that adopting withholding was followed by real income tax revenue per head rising by around 29%. Income tax revenue, not the whole budget. Suggestive is what I will call it. Along the way, the government did something else, which was to teach 100 million people that this was normal. The Treasury commissioned Walt Disney to make a short film. Henry Morgenthau wanted a character called Mr. Average Taxpayer. Disney told him he was getting Donald Duck instead, and Disney won. Congress, in a nice detail, refused to appropriate the $80,000 for the cartoon. And Irving Berlin wrote a song about it called I Paid My Income Tax Today. And one of the young economists working in the Treasury's Division of Tax Research, helping to design the withholding system, was Milton Friedman, who spent much of the rest of his life arguing that the American state was too large, and who wrote in his memoirs that he had no regrets about doing it during the war, but that he wished there had been another way to finance it. Now, there is an entire industry attached to this subject, books, seminars, courtrooms, people who have gone to prison for believing it, and I am not going to hand it a weapon. Nothing in this story is a conspiracy. It is very close to the opposite of one. There was no room where men agreed to trick America into a permanent tax. What there was a parliamentary maneuver that failed in an unexpected direction, ratified by legislators who mostly believed it would never touch their constituents, and then twice repriced by wars that nobody in 1909 could see coming. Bunker's line stands, less conviction or enthusiasm than almost any measure of comparable importance. So let me take the 3 claims you will actually hear in order and give you the real answers. The first is that the 16th Amendment was never legally ratified, the argument built on those spelling and punctuation errors in the state documents. Those errors are real. I told you about them. What is not real is the conclusion. Those variations were examined by the State Department in 1913, judged trivial, and certified. And when the argument was resurrected in the 1980s, the federal courts went through it again. The Seventh Circuit's opinion is worth quoting because it is so dry. The men making the claim, the court wrote, did not discover anything. They rediscovered something that Secretary Knox considered in 1913. And Secretary Knox's decision, the court added, is now beyond review. The second is that the 16th Amendment created a new power to tax, and therefore that some categories of earnings fall outside it. Read the Supreme Court in 1916 in the case of Stanton against Baltic Mining. The amendment, the court said, conferred no new power of taxation. It simply prevented the power Congress had possessed from the beginning from being pushed out of the category it had always belonged to. That is the opposite of what people think the amendment did. It did not grant a power. It repaired one, after a single 5-4 decision in 1895 had damaged it. The third is the one I hear most because both things happened in 1913, that the income tax was created to pay interest to the Federal Reserve. Look at the calendar. The amendment was certified on the 25th of February, 1913. The Federal Reserve Act was signed on the 23rd of December, 1913, 10 months later, by which time the income tax had already been law for 11 weeks. The instrument cannot have been built to serve a thing that did not yet exist. And I will tell you something more interesting than the myth, which is that there is a real connection, and it is not the one people reach for. Nelson Aldrich is in both stories. He did not write the income tax amendment. A Nebraska Republican named Norris Brown introduced it out of Taft's message. What Aldrich did was let it through on a calculation that went wrong. And the following year, he chaired the secret meeting on Jekyll Island that produced the first draft of a central banking plan. We made a whole video about that one. He lost both times. The amendment he waved through as a maneuver was ratified, the banking plan he drafted was rejected, and the Federal Reserve Act that passed in December 1913 was somebody else's bill. The same man, two maneuvers. Both of them turned against him inside 4 years. That is a much stranger story than a conspiracy, and it has the advantage of being true.
So what is the real lesson here?
It is not that somebody stole something. It is something quieter and much more useful, and it is this. A tax is not defined by its rate. It is defined by its threshold, and the threshold is the part nobody writes into the Constitution. The 16th Amendment is 30 words long, and not one of them is a number. There is no exemption in it, no rate, no bracket, no definition of rich. All of that lives in ordinary legislation, where it can be moved by a simple majority in an emergency, and where it stays after the emergency ends. In 1913, the American income tax began at 9 times income per head. It was, in the most literal sense, a tax that was never meant to reach you. Everyone who voted for it in the state legislatures was told exactly that, and it was true when they were told it. 30 years later, the same tax began at less than half of average income, and it arrived by subtraction from a pay envelope, so that most people who paid it never handled the money at all. Nobody hid this. It was voted on, printed, debated, and reported. It simply happened at a speed and in a vocabulary that made it very hard to notice, because the thing that changed was never the principle. It was always a number in a schedule. And the other half of this story finished quietly too. In fiscal 1913, customs duties were 44% of what the United States government collected. In fiscal 2024, they were 1.6%. The individual income tax, which was 0, is now about 49%. The two lines crossed. A republic funded by taxing goods at its borders became a republic funded by taxing the labor of its own citizens, and there was no single day on which that decision was made. Which makes the present moment worth watching, because the argument of 1909 has come back, and it has come back inverted. In 1909, the question was whether an income tax could let America cut its tariff. The question being asked out loud now is whether a tariff could let America cut its income tax. Same two instruments, same trade-off, the arrow pointing the other way. If you want to know how that argument ends, do not listen to what anyone says about fairness. Watch the thresholds, watch the exemptions, watch which taxes are collected in a way you can see, and which ones are collected in a way you cannot. Because the men in that Senate chamber in 1909 were, every one of them, arguing about principle. And the thing that actually decided the next 100 years of American life was a number, $3,000, that almost nobody in the room thought was worth fighting about. That is usually where it is. If you made it this far, drop the number 1913 in the comments so I know you stayed till the end. And tell me one thing. Before this video, did you know that withholding was in the original 1913 law? I genuinely did not until I went and read Section 2. I read every comment. If this kind of deep dive is what you come here for, the documents, the page numbers, the part where we tell you which half of our own argument does not survive contact with the evidence, then subscribe. It genuinely helps these keep coming. I'll see you in the next one.